Okay, this week we're going to talk about drilling and development. I apologize that you can't see me this week. This is the second room I have been in. The first room, the recording equipment was not working there, and in this room apparently I can get sound, but I can't get the feed to video myself. So that's okay, you'll have the sound. You just won't be able to see me in this one, so don't worry that something on your computer is malfunctioning. The problem is on our side. So we've been talking about successful efforts. We've acquired fields, we've done testing, and now we're finally going to get to drilling wells. So that's what we're going to look at. How do we do this drilling well thing, and how does that show up on our financial statements? Now, most of you have a background in energy. So most of you are really familiar with how companies work with drilling contractors, if you're an upstream. But for those of you who don't have an energy background, and there are some of you, I'm just going to give a very basic background here. So most upstream companies do not have their own drilling companies. They use outside drilling contractors. Like ExxonMobil uses an outside drilling contractor. They don't do their own drilling. Now, there are some companies with upstream operations that do have subsidiaries that are their own drilling contractors, and that's fine. But for the most part, there are drilling contractors who specialize in just drilling, and the upstream companies hire those as contractors. Now, parties can contract to do anything they want to do. They can contract to do anything. But these are some common ways we might see drilling contracts. I'm just going to give you a few commonalities. There could be a footage or a meter rate, which means I'm going to pay an amount per foot drilled or an amount per meter drilled to the contractor. In a day rate, I'm going to pay an amount per day that they're drilling. And a turnkey contract would be some kind of combination. I might pay you an amount per foot up to 6,000 feet, and then an amount per day after that. Okay, some drilling terms. I didn't really learn these drilling terms very well until I went to work for the oil company. And what they had me do was read the daily drilling reports because they knew I needed to really learn to speak their language. And those of you in the industry know that there's a whole language for the energy industry. These are just a few terms. You can get whole dictionaries of terminology used in the energy industry. Now, the reason the accountant needs to know this, why? Well, the accountant has to know how to account for what's going on in the field or what's going on in the platform, right? It's substance over form. We need to know the substance of what's happening so we can properly account for it. So we're going to go over some drilling terms. Spudding in or spud in is the first one. Generally, that's considered the day the bit hits the earth and starts turning, or some people say the bit cracks the earth. That could be the seafloor, could be the surface of the earth if it's onshore. But generally, we have drilling pipe, right? At the end of that drilling pipe, or at the bottom of the drilling pipe, there's going to be a bit. Usually it's a roller cone bit, kind of has three cones that turn. They have diamond studs in them that cut the rock, because the diamond is harder than the rock. That cuts the rock, the cuttings come up. So spud in is the day actually the bit hits the earth's surface or the seafloor and starts turning, cracks the earth. Tripping in and tripping out, these are ones that I had no clue what these were. And truthfully, when I first went to work for the oil company, we had one well that was tripping out for days. Days and days and days, it seemed like. And I didn't know what it was, and so finally I got brave enough to go talk to the engineers. And of course, they thought it was somewhat funny, I was the young kid, that I didn't understand their terminology. But after a while, I got to know their terminology a little better. And of course, I worked with the engineers every day, so I got to speak their language, and occasionally I might get them to, understand a little bit of my language in accounting, but not too often. But tripping in and tripping out, if I am tripping out, again, we had this well that was tripping out for days. Well, what it was a well in the South marshlands of Louisiana. Now, it wasn't in the Gulf of Mexico, but it wasn't really onshore. South Louisiana, really south, that's the marshlands, right? It's not solid, so it's kind of like offshore, but not really offshore. But you have to have special technology kind of to be in these kind of areas. Well, we were tripping out, and that well was at 18,000 feet. Well, what tripping out means we're pulling all of the drill stem out of the well. 18,000 feet of drill stem. Now, one drill stem or one piece of basically drill pipe is 30 feet. We can usually pull 90 feet out at a time, 3 strands at a time. So 90 feet come out, we kind of unscrew those, right? Put that to the side, go back, get another 90 feet. And going to 18,000 feet, that can take days. There's lots of reasons why we might have to trip out. A common one would be my drill bit has worn out. I need to replace the drill bit. Okay, so I replace the drill bit and then I trip back in, which again may take days. I'm going to put the whole drill stem back into the hole. Blowout is something that I think everyone knows what that is, only because it's in the news whenever it occurs. And of course, the last big one was the BP Deepwater Horizon in the Gulf of Mexico, that they had quite a bit of trouble getting control over. Now, as we talked about, oil and gas are formed from organic material, and we talked about if there's good porosity and permeability, the oil and gas are going to try to reach the surface. That's through the force of gravity, because gas is lighter than oil, which is lighter than water. So oil and gas are having natural pressure to come up. We have to make sure that we are in control of that pressure as we're drilling through zones where there are pressure, or where they, we have to know what the pressure is through different zones we're drilling through. So just to have a little picture on here, I'm not a good drawer, but for those of you who aren't in the upstream, basically if this is the surface, let's say, that's the surface. And at the surface, we're going to spud in with a fairly large diameter drill bit. We're going to start drilling. And at some point, we're going to put in what we call surface casing. Now, this surface casing protects the wellbore. It also keeps the ground or the water table safe from contamination. So your surface casing is going to go, if this is your water table, let's say, it's going to go below your water table. So what you're doing, casing is a hollow pipe. I have drilled this big hole. I'm putting in this hollow pipe, and around here they tend to say it's usually about 75 feet. That protects the groundwater. And then I'm cementing that hollow pipe into the sides of the wellbore. Now I want to continue drilling. So I'm going to put the drill stem back through that surface casing, and I'm going to keep drilling. Now, every once in a while, to protect the wellbore, I'll put in more casing. Now, a new string of casing would be called intermediate casing, and that's going to go, it's going to be put inside the surface casing and go a little further down. The engineers determine all this, right, and cement it into the wellbore. And I may need more than one string of intermediate casing, so every time I put in this hollow pipe, right, it's going to be a little smaller and drilled into the wellbore. It's got to go inside the other pipe. One thing I'm going to do, though, where I don't have casing down here, say at the bottom where I'm drilling, I've got my drill pipe with my bit on the end. Let's see, the bit's down here. The bit is cutting the rock. Mud is going through the drill pipe. And the mud is also carrying the rock pieces back up to the surface. So the mud comes back up to the surface. We take the pieces of rock out and we recirculate it. I'm not a very good artist, obviously. You have no idea what that really would be if you don't listen to the explanation very carefully. But nonetheless, the mud helps put pressure against, in these areas where we don't have casing, and I kind of drew too far to the bottom here, but these areas where we don't have casing, that mud is helping keeping pressure against that exposed wellbore. So usually we have someone called a mudman on the job. Now, a mudman is really a type of engineer. It sounds like a low-level job, but it's really a type of engineer. And as I am reaching formations or areas where the pressure is higher, as I'm reaching those areas with my drill bit, I need to make the mud heavier. I'm going to add clays and sediments to the mud. That will make it heavier and put more pressure against that exposed wellbore where it's exposed. Okay, so as I hit areas where the pressure is going up, I need to make the mud heavier. The mudman is going to keep control of that. So a blowout is going to occur because somehow I didn't keep control of that, right? We call that mud pressure hydrostatic pressure. I let my hydrostatic pressure, the water and the mud and the silts, the water and the silts make the mud. That hydrostatic pressure fell below the natural pressure of the area where I'm drilling. So my hydrostatic pressure was not high enough. Therefore, the oil and gas, let's say if I'm in that producing zone, that oil and gas are shooting up to the surface. Now, usually at the top, you do have blowout preventers, and usually there's two of them, and they will cut off the whole wellbore. Now, of course, in the BP Horizon, Deepwater Horizon, they said that both of those failed. Both of those blowout preventers failed. But basically, a blowout is we've lost control of that pressure. Okay, what is fishing? Fishing is there's something down at the bottom of the wellbore that I have to get out. So I'm actually going to fish for it. That's basically what it is, because we'd be fishing for days. And again, I didn't know what we were doing. We were fishing. Now, what are we doing? We're fishing for days. So maybe a piece of drill pipe broke off, a piece of drill bit broke off, someone dropped a tool in the hole. I know our reports would always say fishing junk in hole. So what we're going to do when we're fishing is we're going to lower a wire line in often with maybe a magnetic device on the end of it. And basically we're trying to get what's down there with a magnet and pull it back up. Sometimes you might have a hooking device that you're trying to hook something, but you're basically trying to pull it up like you would if you were fishing. Now, sidetracking is something that we often did after we did fishing for a long time. Right? We couldn't get what we wanted to get through fishing, still down there. One thing I can do now is go around it. And it could be, it's not just that there's a tool there. I could have to sidetrack because of some way the formation is made. But I have to sidetrack, or instead of drilling straight down, I'm going to go around what I say couldn't fish out, and then I'm going to come back around it and start drilling again. Logging, again, that's something that the engineers understand a lot better than I do. But every once in a while when I'm drilling, I'm going to do some logging, which means I'm going to lower into the wellbore logging equipment that sends out electronic impulses to the wellbore as it's going down. I get some kind of electronic response back from that. The engineers can then interpret that and tell us a lot about the wellbore and what's there as we're going down. Perforating. Okay, we talked about this intermediate casing. When I get to the producing zone, I'm going to put in production casings. Let's say the producing zone down at the bottom. Here's the producing zone. I'm going to put in production casing. I'm going to cement it that end to the wellbore. Okay, now I'm ready to produce, but I can't produce because there's pipe cemented around that hole where I need to produce from. So what am I going to do? I'm going to shoot holes into the pipe or perforate the pipe. I'm going to lower a perforating gun down into the wellbore to the zone, to the depth at which I'm going to produce, and that gun is going to shoot out high-pressure gases and particles, sands, beads, that are going to actually put holes into that casing, that production casing, that pipe, and then that's going to allow me to produce. Fracturing or fracking, I think everyone's heard of that. It's such a political issue now. You know, we had been fracking in Texas for so many years, just so many years, and no one thought anything of it. It's now beginning to be a big environmental issue in many parts of the country, even in Texas in some places. Of course, now we have fracking where we're doing it a little differently because with the shale plays, we have a lot of horizontal drilling where we're drilling kind of down to a certain depth, but then we go basically horizontal across. And then we are fracking in several different places on that horizontal line. And what we're doing when we're fracking is we're trying to increase permeability. Okay, so what we've got is some tight formations so that oil and gas can't really flow very well. But if I send out, basically when I'm fracking, I'm putting in fracking fluid, sending it out at very high pressures at certain spots, right, where I want to produce from, sending it out very high pressure, and again, it has sands and things in it. So what it's going to do is create little channels, and the sands are going to have to keep those channels open so that I can then produce. Again, fracking is very controversial because, you know, some people would say, oh, it contaminates your groundwater. Of course, the industry would say if it's done properly, it's very safe. Other people, we might hear us talk about earthquakes. Actually, these earthquakes are being caused by fracking. I'm not sold on any of that, but this isn't a political debate in this class. I will say, you know, I've been to New York. My daughter lives in New York. And about 3 years ago, I guess we were just going around one of the parks. It wasn't big Central Park or anything, but there's parks all over New York. But we were in Manhattan in one of the parks. There were people holding up the sign saying, stop the fracking now, and they had their little picket sign circle going. You know, they have banned fracking in upstate New York. That's controversial even there because there are a lot of mineral right owners there, individuals who would like to get the royalties, but they're not going to be allowed to, right, because they have banned fracking, at least for now. Acidizing kind of tries to do what fracking does, the same idea. We're sending acid into the reservoir area to try to create more channels. And then we already talked about horizontal drilling. We can drill in directions. We can drill horizontally through technology. Often that's through gas, a certain type of drill bit we use, and it has high pressure gas is exerted on this drill bit, and then that pushes the drill bit into a certain angle. So the amount of pressure we put on is going to determine the angle. Okay, so let's get to drilling. Successful efforts, exploratory drilling. Remember we said exploratory wells are going to be expensed if they're dry because they're not successful. But they'll be capitalized or put as an asset like wells and equipment if they are successful. So all development wells are capitalized. Again, development wells are drilled for a different purpose. All development wells are capitalized because we have a known asset and a known resource. So all wells are capitalized because we know that we have an asset there. We're just going to write those costs over that asset. They're drilled for a different purpose. And in the U.S., a development well is a well drilled in a known area, approved area to approved depth. So if I'm in a field and I found a reservoir at 8,000 feet, that's great. But let's say I think there might be another reservoir at 12,000 feet, so I drilled at 12,000 feet. That's an exploratory well, that additional drilling, because I haven't found the reservoir yet at 12,000 feet. In the UK, they tend to say anything in a known area, even if it's at a different depth, is going to be development. But in the U.S., which is generally what we're dealing with mostly, when you're going to a different depth than you've already found a reservoir at, that's considered an exploratory well. Okay, so this is just what we said. Again, exploratory wells, if they're dry, expense them in the income statement. That's going to reduce income. If they're successful, capitalize them. They're an asset on the balance sheet. Development wells are always going to be an asset on the balance sheet, always capitalized. Okay, so IDC, intangible drilling cost. IDC stands for intangible drilling cost. So as we're getting ready to drill and drilling, we are going to divide our cost up into intangible drilling costs and tangible, or you might just say equipment cost. Why do we do this? We do it for a tax purpose. Now, this is not a tax class, but I will say we do this for a tax purpose. There is a tax incentive to do this. And the reason is anything I can classify as an IDC, as an intangible drilling cost, is if I am an independent company, in other words, I'm not integrated, I don't have a refinery, I don't have midstream, I don't have downstream, I'm just upstream, I get to take my IDC cost immediately in the year I incur them. If I'm an integrated company, so I do have some downstream, maybe some midstream, some upstream, I don't get to take my IDC in the year in which it's incurred, but I do get to write it off faster than if I just used the normal tax code rules for equipment types. So there is a tax advantage to this. Now, from time to time, you hear about them doing away with this tax preference, they call it. It has never happened. It's been talked about time after time after time for many years. We heard about it, I don't know, 4 or 5 years ago, quite a bit, but I haven't heard about it a lot recently, but you never know, because from administration to administration, things change. You know, the current administration at one time did want to do away with that, but politically that just wasn't going to happen. So for right now, we still have this IDC tax preference. And so what that preference is trying to do is trying to encourage companies, U.S. companies, right, who pay U.S. taxes, trying to encourage you to drill. So I can find resources, right? I need to find my nation's resources. I need to find these resources. I'm going to give you a tax advantage to drill and find resources. And many other countries do something like this too. It's not just the U.S. So what we say is up to and including installation of the Christmas tree, all of our costs are divided into intangible and tangible or equipment. You can refer to tangible as equipment cost. Now, the Christmas tree, if you think of an onshore well, it is the valves and the pipes on top of the well. They say it looks like a Christmas tree. Sometimes it's painted green, but I've certainly been places where I've seen them painted other colors. People paint them their college colors and so forth on their fields. But it's supposed to look like a Christmas tree. But it's got a bunch of valves and things on it that controls the flow. And it's there, holds up the casing. We have casing head, tubing head, and then the Christmas tree that controls the valves and the flow. So what we're basically saying is the Christmas tree is the last thing that's going to go on before you produce, right? So we're basically saying up until the time of production, or time where you're getting ready to produce, that's your drilling. While you're drilling, we're going to give you this tax advantage. Okay, so what is an intangible drilling cost, or what are intangible drilling costs? I'm not going to give you every one of them because I'd like to try to use your judgment on some of these, especially in assignments. But for instance, labor. I'm drilling a well. Labor, that's an intangible drilling cost. That makes sense. Labor is kind of intangible. I can't buy so many pounds of labor and get it shipped to me by FedEx. It's an intangible drilling cost. But that's certainly not the only intangible drilling cost. Drilling mud is an intangible drilling cost. Now, the general rule is that if something is not salvageable, it's generally an IDC. And if something does not stay with the well, once the well has been completed, ready to produce, if it doesn't stay with the well, it's generally an IDC. This is tax code. There's an exception to rules in tax code. That's why I'm not a tax accountant, to tell you the truth, because there's not always a big, great theory there, right? Tax code is very political. So the idea here is I'm trying to give you a tax advantage, but not all of them seem to fit exactly like you might think, although those are the general rules. If it's not salvageable or if it doesn't stay with the well, it's probably an IDC. So drilling mud is an IDC, not salvageable. I'm going to use it. I can recirculate it in the well, but I'm really not going to take it and use it in another well after. So drilling mud is an IDC. what is tangible or equipment is the casing that we put in the well bore from time to time, surface casing, intermediate casing, production casing, that hollow pipe that we cement in, that casing is tangible. Well, it's not salvageable. I don't take casing out and use it somewhere else, but it does stay with the well when the well's completed. So that somewhat makes sense. Now, the casing, though, is cemented into the side of the well bore, as we said. It's cemented in. The cement, though, is IDC. Well, the cement stays with the well, just like the casing does, but the cement does not have a salvage value. It is an IDC. Now, why would one be an IDC and the other not? Well, that's tax code. The cement's an IDC, but the casing is not. Casing, I guess, looks more like equipment. The one that, first of all, any type of pipe that stays there, like tubing is the smaller diameter pipe that we're going to produce through. That tubing is going to be equipment. The one that first struck me as a little strange, but I guess it makes sense, is the drill bit. A drill bit certainly looks like a piece of equipment. It's very large, or it doesn't have to be large, or small drill bits, depending on what diameter you're in. But they're very expensive. You order them from a manufacturer. They look like equipment. You order them like equipment. They feel like equipment. But they're an IDC. Well, can you salvage a drill bit? Some people say no, but I say, yeah, you can sometimes salvage a drill bit. The school I was at before, I had someone whose family owned a company that reworked old drill bits and sold them. So they can be salvageable. But the drill bit does not stay with the well after the well is drilled. So it would not stay there. So therefore, it is an IDC. The Christmas tree itself, the valves and the pipes on top, right? That on top of the well, when you see it on shore, that Christmas tree itself is tangible, and the labor to install it is intangible or IDC. But as the second bullet says, all costs after the installation of the Christmas tree are considered tangible. So there's no more tax break after the installation of the Christmas tree. So if we're thinking about oil, let's say, flowing through a Christmas tree, it's going to flow through a Christmas tree, then maybe go into some flow lines, which may take it to a separator, maybe then to a storage unit. So the flow lines are post-Christmas tree. So the flow lines themselves, the cost of the flow lines, that's pipe, basically, that's equipment. But the labor to install the flow lines, that's also equipment, because it's post-Christmas tree. The separator is equipment. The labor to install the separator is also equipment, because it's post-Christmas tree, and we're not going to get a tax break post-Christmas tree. So everything post-Christmas tree is tangible. Okay, so now let's finally start looking at some of this drilling. Let's say Peters is drilling an exploratory well on Block A. Intangible drilling costs are $30,000, and lease and well and equipment costs are $200,000. Let's just take that as given. I know those are very odd and low numbers, but and the unapproved property or intangible asset account has a balance of $30,000. Well, that's okay. That was put in 5 years ago when we got the agreement. So now we're drilling an exploratory well, which means this is not a proved field. So as we're drilling, we're usually going to have some type of in-progress account, wells in progress, construction in progress. I called it wells in progress because a well takes a while to drill. Remember, I'm not just drilling a well in a day. So as it's being drilled, it needs to be shown that I'm drilling this well. It's on my balance sheet, but it's not completed yet. So in that very first line, I've got wells in progress, IDC is going to be increased in my balance sheet, $30,000. So wells in progress is an asset account. Wells in progress, lease and well equipment will also be increased on the balance sheet, $200,000. So that well in progress, again, is an asset. Cash is going to be decreased by $230,000, or if I haven't paid the contractor yet, I could say, instead of cash being decreased, accounts payable would be increased as a liability on the balance sheet. That's fine. But eventually, cash is going to be paid for it. So I just put cash is decreased here. Now, if the well is dry, this is successful efforts. If the well is dry, it's got to be expensed. So on the very next part says, assume the well is dry. Well, that $230,000 I paid to drill that well has got to go to dry hole expense on the income statement. So dry hole is expensed on the income statement, $230,000, and the assets come off of my balance sheet. So credit wells in progress or decrease wells in progress IDC on the balance sheet, $30,000. Decrease wells in progress, lease and well equipment on the balance sheet, $200,000. Now, if the well was successful, though, the very last entry, all I'm going to do is take those out of wells in progress assets and put them in wells and equipment assets. And that lets the financial statement reader know they're not in progress anymore. These are completed wells. So I am going to increase a well and related equipment and facility, IDC, on the balance sheet by $30,000. I'm going to increase wells and related equipment and facilities, lease and well equipment on the balance sheet, $200,000. I'm going to decrease wells in progress, IDC, on the balance sheet, $30,000, and decrease wells in progress, lease and well equipment on the balance sheet, $200,000. So I'm just taking them out of the wells in progress assets and putting them into the wells and related E&F equipment and facility assets. Now, what if this were not an exploratory well? If this were a development well, that second part would not be true. I would not put a development well to dry hole expense if it were dry. A development well would still have this last part happen to it, the last part, just like a successful exploratory well. The development well would be transferred from wells in progress, from those assets, to wells and related equipment, because development wells are always kept as assets, so they would be transferred out, or wells in progress would be decreased, and wells and related equipment and facilities would be increased. Okay, workovers. Once a well starts producing, every once in a while it needs some kind of maintenance or workover. This is basically handled the same U.S. and internationally. And generally, let's go to the third bullet, because generally a workover just maintains production, and I'm going to expense that. It's an OPEX or a lifting or production cost. I'm going to expense it. So if my tubing gets clogged with paraffin, like with wax or with sand, I need to go in and clean out the tubing or maybe replace the tubing. That's just maintaining production. I'm going to expense that. But if the life or productivity of the well is materially increased, then I would capitalize that cost. Now, that's going to be rare. That's probably more of a recompletion. So I have finished producing at 10,000 feet. I'm now going to recomplete to 14,000 feet where there's another reservoir. Therefore, I'm going to get more reserves. Well, that could be capitalized, but it's not really a workover. It's really a recompletion. So in this one, Peter's paid $60,000 for a workover on well number 1. Now, if it takes some time to do it, first thing I might do is put this in workovers in progress, and that's an asset for now, increased in the balance sheet. If I'm paying a contractor, I'll decrease cash if I assume I'm paying them right now. If the useful life of the well is not increased, in other words, I'm just maintaining production, cleaning out tubing, cleaning out paraffin, replacing a downhole pump, something to keep production going. That's the norm. OPEX, or operating expense, is going to be increased in the income statement, so expense is going to go through the income statement, and that workover in progress asset is decreased in the balance sheet. In reality, many of these workovers, they're done very quickly in 1 or 2 days, so in reality, many companies won't even put it in workovers in progress first. They'll just go right to OPEX, expense it in the income statement, and then credit or decrease cash in the balance sheet. Now, let's say that, though, this is really a recompletion, maybe at a different depth, and I do get more reserves because of it. Then the cost of this workover will actually be added to wells and related equipment and facilities, lease and well equipment, increased in the balance sheet. I can capitalize it because I'm going to get more reserves than I ever thought I was. Or I thought it, were more reserves than were on my books before. And then I'll credit workovers in progress or decrease that in my balance sheet. Okay, service wells are always capitalized as assets. Service wells are wells that I'm using for some purpose other than producing. Water wells. If I'm drilling in West Texas, the first thing I need is a water well. Get that mud, that drilling mud, I need water. but also injection wells, steam injection, gas injection, things to try to get more out of the reservoir. Also, when I'm drilling onshore, I'm producing salt water. I've got to inject that salt water back at a safe depth into the earth where it's not going to contaminate groundwater. That's a service well. They're always capitalized. So here, Peters drills a gas injection well on Block A at a cost of $80,000. As it's being drilled, I will add that as an asset on my balance sheet, wells in progress, lease and well equipment. That's going to increase assets on my balance sheet. So let's say I'm paying the contractor, so I'm decreasing cash in the balance sheet. When the well is completed, that well in progress on the balance sheet is going to come off. That's going to be decreased, but I'm going to put that into wells and related equipment and facilities on the balance sheet, lease and well equipment. So I'm just moving it from an in-progress well account to a wells and related equipment and facilities account to show that I've now finished that service well. Okay, and then finally, I've got capitalization of interest. Now, capitalization of interest is something that is required both in the U.S. and internationally, and it's done very, very similarly. It's not just for the oil industry, but for any industry where the companies in that industry, where those companies are self-constructing long-term assets. So if I am a contractor and I build skyscrapers, it takes me over a year to build them, I'm going to capitalize interest while I'm building those. So we kind of say if we're working on a field, it's going to take, quite a while to work on this field. Some of them can take, 5 years before I start producing. I'm going to capitalize interest during that time. So U.S. interest is capitalized during the construction phase based on average accumulated expenditures, which is a little different. Same thing internationally, though. The rate used to compute capitalization should be the rate of a specific borrowing for the project, if there is one, up to the amount of the borrowing. If the borrowing is done centrally, like ExxonMobil doesn't do a lot of borrowing just for one project. They kind of do their borrowing centrally at a corporate level. And then they kind of, send funds to different projects as needed. So if borrowing is done centrally, the rate used should be the average borrowing rate for the company. Again, similar under international GAAP. So here is an example of interest capitalization. Peters has unproved property cost on Block A of $40,000 on January 1. During the year, Peters incurs exploratory drilling cost of $400,000 on June 1. And an additional $300,000 on October 1. A $200,000 8% note was outstanding during the entire year, specifically for this block. Total interest cost for the company is $800,000 with an average borrowing rate of 7%. This is average accumulated expenditure. So we're going to say as of January 1, what were the costs I had already accumulated on this block? Well, as of January 1, the only costs I had accumulated were those unproved property costs. So those unproved property costs were outstanding 12 out of 12 months this year. So that first line, $40,000, is going to be weighted 12/12. Peters then incurred exploratory drilling cost of $400,000 on June 1. Well, June 1 through December 31 is 7 months. So that $400,000 is going to get weighted 7/12. Then I spent an additional $300,000 on October 1st. Well, October, November, December, that's 3 months. So that $300,000 is outstanding 3/12 of the year. So I'm going to weight those and total them. That gives me average accumulated expenditures, $348,000, $333,000. That's the amount I want to capitalize interest on. I do have a note outstanding all year for this block alone at 8%. The first $200,000 that I capitalize then will be at that specific 8% because that's a specific loan for this project. $200,000 at 8% is $16,000. But I want to capitalize interest on a total accumulated expenditure of $348,000, $333,000. So I have another $148,000, $333,000 to capitalize. I'll capitalize that remaining amount at the average borrowing rate for the company of 7%, or $148,000, $333,000 at 7% is $10,383. So that's a total capitalization of $26,383. That will be added to wells in progress on this field. IDC, increased in the balance sheet. That will be added to wells in progress. It's part of the cost of getting this field developed, explored, developed, and produced. And then I will decrease interest in my income statement. So the company as a whole has $800,000 of interest expense that's normally going to go to their income statement, right? What I'm saying is I'm going to decrease that interest expense by $26,383, and instead that amount will go in the balance sheet this year for wells in progress on this field. Now the idea is I'm capitalizing avoidable interest. If I hadn't done this project, I wouldn't have needed that special loan. And if I hadn't done this project, I could have paid back some of the company's debt. Instead of doing this project, the company as a whole would have had less interest. So we're saying that this interest could have been avoided by not doing the project. So the avoidable interest is part of the cost of the project. Again, if I bought a skyscraper from a contractor who had already built it, in his price, he billed in some amount for the use of his funds, which is basically what we're doing here with interest capitalization. And this is a requirement, unless, of course, it's immaterial, and every company has their own immateriality levels. Okay, so that's it for drilling. Please let me know if you have any questions. Thanks.